Everything you need to know about products and services that can improve your life. This is Experts on Call on CL 650.
And welcome back to the show. This is Experts on Call featuring IntactInsurance on CL 650. I'm Joanne Sutton. Today's experts are from the Gear Pelling Insurance in Richmond. And joining us in the studio, we have resident broker Andrew Tablotny, along with broker Sanjeev Katoch. So we've been talking so far today mostly about life insurance, the basics of what it is, why it's important. But I've always felt that the only way for a layperson to understand anything about the insurance industry is if I went to the same school that you guys did. I get a little intimidated, and I think I can share that some of our listeners might be as well. So we're here to hold your hand through this process, and don't shy away from buying insurance or even asking questions about it. And we know that there's a lot of myths about insurance, so we're hoping we're going to tackle some of those topics right now. One of the most common life insurance myths is people just don't think they need it.
That's because they think they're never going to die.
Well, we're all going to die. Sanjeev?
No one is immune to having to pay back his or her financial obligation after death. So if you have mortgage, vehicle to pay off, credit card, student loan, debt that has been accumulated, life insurance is a simple solution. If you die unexpectedly, and no one waves a magic wand and makes these responsibilities disappear. Life insurance relieves your family members from potential problems.
You know, Andrew, I think you've talked about this on previous shows. Like we just don't think about what's on the other side. Like
we live in today's world and don't think about what's going to happen down the road.
We don't think about what happens down the road. But truly, if something, the unforeseen did happen and somebody lost their life, say today, who's making that car payment tomorrow or the house payment, right?
Yeah. Well, that's the problem, right? And if you have, especially if you're married, you may have, set up funds for your children's education or RSPs and things like that. So if you don't have the life insurance, then you're going to end up having to dip into those funds.
Okay, so let's talk about some people's kids. I'm young. Why would I start spending my money on life insurance now? I'm only, say, 25 or 30.
Yeah, I bought my first policy at 25, and it's the problem is not the problem. The reason is that the premiums are so cheap. When you're young, you're expected to live another 55 or 60 years, so the premiums are very cheap. So you can lock in a long-term policy for very few dollars. I did that. I've got a policy that I bought back in the 80s. It's $435 a year. I paid for $200,000. Well, now it cost me 5 times that to get that sort of coverage. So it's you can get it while you're young, and you still have potentially debts that need to be looked after, or if you're in a relationship, you need money to cover your funeral costs and things like that. You don't want your parents to have to be forking out money to pay for your funeral because you didn't make any plans.
So really, a person at 25 or even younger, or just say anybody under 30, could actually buy a policy now that would cover them till they were 90 if they lived that long?
Typically, these policies, like the younger you apply, the longer term you can be qualified for. The maximum term come in the available in the market is 40 years.
40 years.
40
okay.
years. So let's say if based and these are renewable up to 80 years. So after 80 years, it's very hard to find, but still there are markets for that.
So you could strategically sort of time that through the periods of your life.
Yeah, well, the policy I have actually is termed to 100. I don't know if they even sell that anymore, but
probably not.
Yeah, so so I'm good. I know I've got at least 200,000 till I'm end up at 100. So
yeah, but the other good thing about that is if you choose to have permanent life insurance, that covers you for your whole life. So you can choose to pay them off in 10 years, 20 years. If you're young and earning more and have, let's say, 100,000 in place, just pay it off in 20 years while you are earning, and you have that 100,000 coverage for the rest of your life, even if you live 110 years.
That's a very good recommendation. Okay, here's another myth. I'm a stay-at-home parent. There isn't a need to replace an income because there isn't an income. So what do I need insurance for?
Yeah. If you stay at home parent and you pass away, your spouse may not be able to afford childcare for your kids, right? This means that they may have to spend your savings like for their education or their RSP fund. So if this protection is available, so your spouse can still pay for some help for your kids and for their education, and they don't have to dig into their savings.
Leaves you in a good financial position. Essentially what it is, it's financial planning, what it is.
It is financial planning.
It's very simplistic financial planning. I mean, it's not sophisticated, but it's the simplest form of financial planning.
See, that's like going to the dentist. That's another topic we don't like talking about. Okay, what about if somebody is a smoker? Insurance companies aren't going to insure me because I smoke.
No, that's an old myth, and you're going to pay more because you're potentially going to die sooner. So I mean, we know that statistically. So, but you can still qualify. I mean, it's just like saying if I'm 58, can I get insurance? Well, sure, you can still get it, but it's going to cost you more because you're that much closer to passing away.
Mm-hmm. Okay, so here's a question about the difference between life insurance and, say, mortgage insurance. If I want my mortgage to be protected, oh, sorry. Oh, yeah, I skipped a question. Yeah. Okay, here's a question for somebody who's employed that I happen to get life insurance through my place of employment, through my job. Why would I need to buy anything that's additional?
Joanne, life insurance you get through your employment group plan is likely not adequate coverage for you. Some employer allow you to increase your limit. The problem is that statistically, say, you may have 3 to 7 different jobs in your lifetime. If you get sick, you may not qualify. If you move, or more importantly, if you're let go from your position, you are now suddenly uninsured. So your life insurance is sort of protection with you all through your life, and even if you change job, this policy goes with you. So you're not in an awkward position when you're laid off or let go from your job and you have no insurance at all.
So it only covers me if I'm being supplied life insurance through my employer. It's only covering me while I'm employed for that employer.
Right, and if you get ill in the meantime, then you don't qualify for any more insurance. So then if you do leave the job, you've got no insurance, and the ability to buy any.
Okay, so you've implied that it may not be adequate coverage for me. So if I go and get another separate life insurance policy, that I'm just sort of covering all the angles.
All the bases, yeah. Well, then you've got something that's permanent that they can't take away from you, which leads us into our next topic, which is mortgage insurance, right?
Well, yeah, okay, so that was a good one. And this one I've talked about with my friends on numerous occasions. Why do I need to look after that through a life insurance policy if I've already bought mortgage insurance through the bank?
Yeah, well,
my house is looked after. My mortgage is looked after.
And we have a real problem with that because when you're sitting there at the bank and they've now just loaned you money, they stick a form in front of you and say, oh, by the way, here's some more, you probably want some mortgage insurance, and you feel obligated and sometimes intimidated to have to buy it from them. The problem is that they're not offering the best product. The people that are selling to you are mostly unlicensed, so they really don't know the ins and outs of what's going on. And the real issue is that it's you're buying a policy before you die. So what happens is they underwrite the policy afterwards. We call it post-underwriting. And so that after the fact, they now suddenly say, oh, well, let's check her application. Did she tick this box the right way? And if you didn't tick it the right way, suddenly you find out you're not going to get paid. And this is, it's a real problem. Whereas you buy life insurance, we underwrite you at the time of the risk. We ask you all the questions. You understand what it is, and then once you've qualified, then you've got that policy. There's no chance that policy is going to be taken away from you down the road.
So what I'm hearing you say is there's risk involved with some of these other policies that are in place, as opposed to a nice general life insurance policy that I would acquire on my own.
Well, it's not a risk. I guess you could say there's a risk. I mean, there's a risk that you may have misunderstood what the question was. I mean, we've had this conversation before about direct writers, and the same thing happens where you go in, you tick some boxes, and you don't necessarily understand the particulars on that question, and next thing you know, you have a claim, and the insurance company says, oh, well, you ticked box and you said yes when it should have been no, and now we're not going to cover your claim.
That's right, and it's also something that should be revisited. Like, I might have signed my mortgage or bought that insurance X amount of years ago, 10 years ago. Should I go back and try to update that, or refresh my memory about what box I ticked?
Well, yeah, they're not going to tell you.
Like Andrew said, that these, most of the people who are selling this mortgage insurance through bank are not licensed to they're not life licensed. So the thing is that there is no thorough medical examinations. So with a life insurance policy, you pre-qualified based on your medical profile. The nurse would come to your place and they will take all the samples, and they'll go into your medical history and then qualify you for the coverage with a certain premium, and that is guaranteed coverage. So this is called pre-underwriting. We pre-approve you, whereas post-underwriting is not guaranteed. But post-claim underwriting is not guaranteed, based on yes or no questions you answered on the application.
Okay.
The other issue you've got too is when you buy mortgage insurance, you're buying a decreasing commodity. So you have a $500,000 policy. In 10 years, you've paid off $200,000. Well, now you suddenly only have $300,000 worth of life insurance. You don't have. Whereas if you had bought a $500,000 policy when you first bought your house, you still have a $500,000 there. And the need for life insurance never goes away, until maybe you get considerably older, and then you may look at reducing some of the number of policies. But there's always a need there to be looking after that.
Well, I think both of you gentlemen have brought forth a very solid argument about why life insurance policies would be better than a mortgage insurance policies. Have we covered off all the reasons why one is better than the other?
I want to add one more thing, Joanne, here is that your mortgage insurance through bank only covers your mortgage. And it's on the mortgage amount left, so which goes on decreasing in future. And like Andrew said, your insurance need is not typically goes on decreasing. It keeps on increasing based on your liabilities in the future. Your life insurance policy, it will cover your mortgage, it will cover your loan, it will cover your student education. That's some money on the table, guaranteed money on the table. And of course, another thing is that on your life insurance policy, you are the beneficiary. I mean, your family member is the beneficiary.
Not the bank.
Whereas in the bank, your
not
bank is
the bank.
Yeah, not the bank. But here, bank will take care of all their money, and then you are at the mercy of your bank how much they pay you, whatever is left after clearing their liabilities.
Yeah.
And the other problem you've got too with mortgage insurance is that you're buying from a bank. So if you want to move lenders and you've suddenly developed an illness, you may not qualify for life insurance or mortgage insurance on a new lender. So now you're forced to stay there. So now you've got a decreasing amount of life insurance. You're forced to stay with that bank, and you're a double loser. You're getting less life insurance, and you can't borrow more money. Or you can borrow more money, but it won't be insured. Whereas if you bought that $500,000 policy to begin with, you've got $500,000. So you've got that flexibility.
I just want to sneak in one more quick question or one more myth or concern. What about if I'm a single parent, I can't afford insurance, or I'm on a pension and I can't afford insurance? What do you say?
Well, can you not afford it? I mean, we've talked about this on the house insurance side. I mean, it's, can you afford to have the place burned down and have to replace all your contents? Can you afford for your kids to have nothing to live on if you happen to die if you're a single parent? I mean, it's, everybody's got a case of beer they buy once a month. So, forego the case of beer and make sure your kids are looked after.
You can't afford not to.
Right.
You're listening to Experts on Call on CL 650. I'm Joanne Sutton, featuring our Intact Insurance experts. Thanks for joining us today. In the studio, we have from Laguerre Pelling Insurance in Richmond, brokers Andrew Tablotny and Sanjeev Katoch. For more information, visit their website, please, laguerrepelling.com. We'll be right back.
This is Experts on Call on CL 650.